Hello, everyone. This is Saurabh. Thanks for joining today's session on the Options Engineer channel. So, let's start with a simple question. If one trade receives $800 and in credit and the other trade pays $1,000, which one is riskier? Most people instinctively focus on premium, but in options, premium is not always the same thing as risk. The real question is what is actually exposed if if the trade goes against you. Here is a simple visual diagram from my platform. I'm comparing different structures in the same general market context. Notice the payoff shapes are different, the opening debit or credit is different, and the capital at risk is also different. That is the key idea. If I only look at premium, I may miss the actual exposure. CAR gives me a more practical way to compare unlike structures. When I started trading options more than a decade ago, one thing stood out to me. Options are powerful instruments, but they can also become speculative if you do not have a disciplined way to evaluate risk. That was the tension for me. Options had tremendous potential, but without a risk first lens, it will easy to focus too much on premium, payoff diagrams, or short term outcomes. Over time, my focus shifted towards risk first. That is where capital at risk became important. It gives me a more grounded way to think about exposure before I get pulled into potential return. The opening premium is only the transaction, capital at risk is the risk lens. When I compare structures, I want to know what the trade can lose under the assumptions I am evaluating. That is especially important when comparing unlike structures, because debit paid, credit received, and model exposure can all tell different stories. My working definition is simple. Capital at risk is model capital exposure under the risk assumptions being evaluated. It is not the only metric, but it gives me a more practical way to think about exposure before looking at return, probability, or win rate. CAR can vary with structure, time to expiration, volatility, skew, and pricing. So I treat it as a dynamic comparison lens rather than a fixed property. In many simple debit structures, the debit paid and capital at risk are close. If I pay $300 for a debit spread, the defined risk exposure is generally around $300. If I pay $250 for a long butterfly, the defined risk exposure is generally around $250. That is straightforward. But the concept becomes much more important when we move to credit structures and more complex engineered structures. Now consider a credit spread example. If the spread is 40 points wide and I collect a $8 credit, the credit received is $800 per contract. But the risk is not $800. The remaining risk is about 32 points or approximately $3,200 per contract if we consider SPX. This is why I do not evaluate credit structures only by the premium collect. Once I have a CAR estimate, I can compare very different structures on a similar risk basis. CAR does not tell me which trade is best. It helps me compare the exposure side of the equation before I look at the payoff shape, probability, volatility, execution, and path behavior. So instead of asking only which strategy made more, I ask what outcome was produced for a comparable amount of model capital at risk. CAR also becomes a design constraint. I can start with the objective, shape the payoff, measure the capital at risk, normalize the sizing, and then study how the position behaves through its life cycle. I still need probability, expected value, liquidity, execution, and trade management. But CAR gives me a risk first lens to keep the structure grounded. Skyline strategies are one of the outcomes of using CAR as one of the key metrics, and you can learn more about one of two strategies research that I have published on my website, theoptionsengineer.com, to see the different research outcomes through backtesting using option omega. Now I'm going to apply the card lens to a live example. I want to connect three things. First, what was paid or collected to open the structures. Second, what the model capital at risk looks like. Third, how the payoff shape helps explain the risk behavior. The goal is not just to name the strategy, the goal is to understand the exposure and the behavior of the structure. So now I'm on my options engineer platform, or the option engineering OS. So what I'm going to compare is three structures that have a different payoff profile, and what their capital at risk is and what the debit or credit received is. So let's start with put credit spread. Here I'm selling a short put at 7420, and at 7400 I'm buying a put. I'm getting this $7.90 in credit, and this is coming through my broker live. So let's add that to the comparison. So we can see this shows the payoff curve and how and where this trade is going to be profitable from a put credit standpoint. If it falls down below certain level, then the trade can be negative, or you could lose the capital at risk. Now let's do a comparison with the iron condor. So we have an iron condor 25 point wide, and we will try to add that into the comparison. So now we have an iron condor. If you look at this, this is a 0.6% wide from the spot, and the capital at risk in this case is $425, and the model peak profit is $2,075. So if you kind of going back to the earlier point in the presentation, the maximum loss in this case is less than the capital at risk in case of the put credit spread, which tells us a kind of a how we compare certain structures on the basis of the capital at risk. Now let's look at a more complex Skyline demo structure and see how that compared to all of the two structures that we looked at just now. So I added the structure. It is a combination of three butterflies, and I will walk through here. So you can see we have three butterflies here, or sorry, not three butterflies, but two butterflies and one condor in between. And the key point to see here, though we have a longer range and more payoff areas, the capital at risk is lower than iron condor, not that much, but it's quite a bit lower than the put credit spread. So that's kind of the key comparison there. And then as we look at the net debit, in this case, the Skyline has the most debit, but lowest capital at risk. So this is where engineered structures like Skyline come into play, where the capital at risk is lower, but the payoff profile is different and debit is higher. So that was the key things I wanted to kind of demonstrate on my options engineering OS platform. So let's move back to the presentation. I hope you like the demo. Please comment if you have any questions on it. The three takeaways from today's session are simple. First, how the exposure. First, know the exposure. Second, compare on risk. Third, improve holdability. Capital at risk is not the only metric, but it is one of the most important lenses I use when comparing option structures. If you found this helpful, please like, subscribe, and leave a comment with topics you would like me to cover. You can also visit theoptionsengineer.com for research updates, the options engineering blueprint, and coaching related resources for traders who want a more structured way to think about option strategy, design, risk, and trade process. Thanks again for watching, and I will see you in the next video. Bye now.